They didn't negotiate. They took control. That's the contradiction at the center of this story. The United States says it's helping Venezuela get back on its feet while openly seizing control of Venezuelan oil exports. Not after a treaty, not after a vote. On record, the executive branch said, "We will take it." Then came the line that stunned even seasoned observers. The president said he didn't have to consult with anybody, not Congress, not the courts, not even the Attorney General. On day one, the value cited was $5.2 billion. Oil moved, custody changed, money shifted immediately. This wasn't diplomacy. It was speed, a shock designed to leave no time for resistance. This matters to you because this oil doesn't just power refineries. It affects gas prices, asphalt costs, construction budgets, and inflation metrics tied directly to your daily life. But here's the part nobody is saying out loud. Venezuela wasn't the real target of this move. The pressure point was inside the United States itself. And once you see why, the entire story flips. What looks like a sudden foreign policy move is actually part of a much larger pattern. Here's what we know. The United States moved to take the majority of Venezuelan oil exports under direct executive control. Not all of it, but most of it. Some barrels would still be sold globally to Europe and Asia, but the bulk was earmarked for the U.S. system. The Department of Energy confirmed the structure. The oil flows through American hands. The sales are managed under American oversight. The proceeds are technically assigned to Venezuela to help the country recover. That's the surface story. But notice what's missing. There's no emphasis on negotiation timelines, no multilateral framework, no gradual phase-in. This wasn't treated as an isolated crisis. It was treated as a mechanical fix. American refineries, especially along the Gulf Coast, were built to process Venezuelan heavy crude. Refiners are described as very anxious to get that crude back. Now ask the real question. If this was just about Venezuela, why the urgency? Why the bypassing of normal process? Or is this about stabilizing something much closer to home, using foreign oil as the lever? Because once you frame it that way, this stops being a foreign policy story. It becomes an infrastructure story. The claim being made implicitly is bold. The U.S. energy system cannot function at full capacity without Venezuela. Refineries in Texas, Louisiana, and across the Gulf Coast were engineered decades ago to run on heavy crude. Venezuelan oil matches that specification almost perfectly. Without it, those refineries operate below peak efficiency. That's not political theory. That's industrial design. These facilities weren't built for flexibility. They were built for volume, consistency, and a very specific type of feedstock. When that feedstock disappeared, inefficiencies crept in quietly. Margins tightened, output dropped, costs hid downstream. Now notice the wording used by refiners. They're described as being very anxious to reintegrate Venezuelan crude. Not curious, not interested, anxious. Anxiety signals pressure, pressure signals exposure. This is where the story sharpens. The seizure wasn't framed as a future solution. It was executed as an immediate correction. Oil physically moved, routes reopened, refining math snapped back into place. But here's the part most coverage skips. There was no public debate about alternatives. No mention of retrofitting refineries. No serious push to adapt infrastructure away from heavy crude dependency. Instead, the system chose the fastest path, reclaim the input. So ask yourself this. If the entire downstream sector depends on one foreign source, who really has leverage here? And what happens once that dependency is fully restored? Now watch how fast this escalates. Once the oil starts moving, the strategy widens. This stops being about refineries and turns into market control. Global oil markets are already on edge. Unrest in Iran is described as unprecedented. Supply disruption isn't hypothetical. It's expected. And in that environment, Venezuela suddenly reappears as what analysts call a sleeping giant. Venezuela once produced nearly 3.5 million barrels a day. Production collapsed to under 1 million. Restarting that capacity would move global prices. That kind of volume doesn't just stabilize markets, it can flood them. And that's the danger. A sudden surge could crash prices or trigger retaliation from other producers. This is where the U.S. move becomes clearer. By taking the majority of Venezuelan exports, Washington doesn't just secure supply, it installs itself as the control valve. Flow can be increased or restricted without public negotiation. Shock is replaced by modulation. This isn't new in concept. Systems that control choke points always outlast systems that argue over principles. But what's different now is how openly this is being normalized. Notice how quickly taking becomes managing, how seizure becomes stability. And here's why that detail changes everything. If the U.S. controls both refining demand and export flow, price volatility stops being a market problem. It becomes a policy tool. This is where the evidence gets harder to ignore. The Department of Energy confirmed the United States will take the majority of Venezuelan exports. Some oil will still go to Europe and Asia, but the bulk is routed through the U.S. system. Control of the sale and physical movement stays in American hands, even when proceeds are labeled as aid to Venezuela. Now listen to the public framing. This is described as helping Venezuela get back on its feet. But notice what they didn't say. There's no mention of Venezuela choosing buyers, no control over timing, no independent pricing authority. Revenue without control is not sovereignty. It's custodianship. Then comes the domestic reveal. The Department of Energy explicitly links Venezuelan heavy crude to a new construction boom inside the United States. Why? Because that oil is a primary feedstock for asphalt, roads, highways, infrastructure. The stated goal is to drive down the price of asphalt, lower asphalt costs, reduce road building expenses, and infrastructure inflation. Here's the contradiction that permanently changes how you see this. The oil is framed as foreign aid, but the first-order benefit lands at home. Cheaper roads, cheaper projects, lower headline inflation. This functions like a subsidy, paid for with foreign resources. And once you see that, the story stops being about helping Venezuela recover. It becomes about using external assets to quietly stabilize internal costs. That's not charity. That's leverage. And it doesn't stop with oil. Now the pressure stacks, energy markets are volatile, infrastructure costs are high, inflation is politically radioactive, and at the same time, electricity demand inside the United States is exploding. Data centers require massive amounts of constant power. The administration has proposed an electricity auction to deal with it. The stated goal is to force large technology companies to underwrite the cost of new power generation. This isn't a small policy tweak, it's a shift in who pays. Instead of residential ratepayers absorbing grid expansion costs, the burden is pushed onto the corporate consumers driving the demand. Notice the speed again. No long debate about fairness, no gradual pilot programs. Just a mechanism designed to extract capital quickly. This is about preventing energy inflation before it shows up on household bills. At the same time, another clock is running. The U.S. is accelerating the deployment of small modular reactors. These reactors are derived from Navy propulsion systems. The target is to have multiple units operational by July 4th. That's not a normal timeline, that's a sprint. This is where the story flips. Oil stabilizes materials, nuclear stabilizes electricity, tech pays the bill, the public avoids the spike, and suddenly these aren't isolated policies. They're components of a single system moving very fast. The question now isn't whether this works, it's what happens if this pace doesn't slow down. Zoom in to where this hits you. When the system talks about oil, it sounds distant. When it talks about refineries, it sounds technical. but the impact shows up in places you actually feel: at the pump, on your commute, in the price tag of a road project that decides whether your city fixes a bridge this year or sometime later, in your electric bill when grid upgrades get passed down the chain. The policy explicitly aims to drive down the price of asphalt. The benefits are described as enormous for American taxpayers through reduced material costs. That's an inflation strategy disguised as foreign policy. And the electricity side matters even more. Data centers don't run part-time, they demand 24/7 juice. That pressure can either raise prices for everyone, or it can be contained by forcing the biggest corporate consumers to fund new baseload generation. The electricity auction is designed to keep the grid expansion burden off residential ratepayers. So here's the lived consequence. If this system works, you don't just get cheaper fuel inputs and cheaper asphalt, you also avoid the hidden tax of rising electricity costs driven by the AI boom. But if it fails, you get the opposite: volatility at the pump, delays in infrastructure, higher bills, and a grid that can't keep up. If this feels familiar, say so in the comments, because a lot of people can sense something shifting even if they can't name it yet. And here's why that detail changes everything. When governments start using external assets to manage internal prices, the next step isn't economic, it's political. Here's the unsettling part. Once you strip away the outrage, this isn't chaos, it's structure. What allows all of this to happen is leverage. The United States isn't just acting as a buyer of oil or a builder of reactors. It's positioning itself as the switchboard. Control the choke points and you don't need constant intervention. You shape incentives and the system moves on its own. The US controls the physical movement and sale of Venezuelan oil. It controls the refining infrastructure that oil must pass through. It is forcing the largest electricity consumers to prepay for future grid capacity. This isn't about ideology. It's about removing volatility from places where volatility becomes politically dangerous. Spectacle plays a role too. Big shocking moves grab attention. We will take it. Nuclear reactors by July 4th. Electricity auctions. While debate focuses on tone or legality, the machinery locks into place. This is why it feels faster than normal governance. The system is designed to move before resistance organizes. Once oil is flowing, roads are cheaper. Once reactors are live, the grid stabilizes. Once prices flatten, public pressure drops. That's the mechanism. Calm the variables people feel most, and you buy time everywhere else. This is smarter than it looks, and more fragile than it appears. Because systems built on leverage don't collapse slowly. They snap when one incentive breaks, and one is already under stress. Now look at where this is headed, because the next move is already forming. There are two paths from here. Venezuelan reserves are described as larger than Saudi Arabia's. US and Canadian oil firms are eager to return, some described as ready to knock down the doors. That return is conditioned on rule of law guarantees and political alignment. Path 1 is acceleration. Investment floods back in. Production ramps faster than expected. Venezuelan output rises enough to offset Middle East instability. The US tightens its grip as broker, stabilizing prices while locking rivals like Russia, China, and Iran out of the revenue stream. Energy stays cheap, infrastructure costs stay down, migration pressure eases as jobs return to Venezuela. Path 2 is friction. Legal guarantees stall, political proxies fail to consolidate power. Production lags, markets sense the gap, volatility returns, and the leverage system that depends on speed suddenly faces resistance. It can't shock away. Neither path is clean, and neither is fully controllable. What matters is momentum. Oil is already moving. Capital is already circling. Timelines are already compressed. The question isn't whether a decision will be made. It's who makes the next one and how much time they have. Because once momentum like this builds, stopping it isn't a policy choice. It's a crisis. Here's the insight that ties all of this together. This was never just about Venezuela. It was about building a system that turns foreign resources into domestic stability, quietly and at speed. Oil lowers construction costs, control smooths markets, nuclear locks in electricity, corporations fund the grid, migration pressure eases, inflation stays contained. Each move only makes sense when you see the whole machine. The policy combines energy seizure, infrastructure pricing, grid expansion, and geopolitical exclusion into one continuous strategy. This isn't short-term crisis management, it's an attempt to hardwire control into the Western Hemisphere. And that's why the tone shifted so fast. Yesterday, Venezuela was a pariah. Today, the president says he's loving Venezuela. Not because sentiment changed, but because alignment did. Cooperation unlocks capital. Capital unlocks production. Production stabilizes everything else. The risk isn't that this fails immediately. The risk is that it works just well enough to be repeated. Because once governments learn they can manage domestic pressure by controlling external assets, the playbook doesn't disappear. It expands. And the next chapter won't start in Caracas. If you want to understand where this goes next, follow and subscribe. This story isn't ending, it's scaling.